On November 2nd, 2022, a single page of private accounting appeared on a crypto news site. 9 days later, an exchange valued at $32 billion was in Chapter 11 bankruptcy, and roughly $8 billion of customer money could not be found. Here is what almost every retelling gets wrong. None of that money disappeared during those 9 days. It had been gone for months, and the market simply had not been told. To understand the fall, price the peak. In January 2022, FTX raised $400 million at a $32 billion valuation from Paradigm, Temasek, and SoftBank, some of the most sophisticated capital in the world. Its founder, Sam Bankman-Fried, was worth an estimated $26 billion by Forbes' count. Stadium naming rights, Super Bowl advertising, congressional testimony. FTX was the acceptable face of crypto. That was the marketing. Now the mechanism. Two entities mattered, and only two. FTX was the exchange, headquartered in the Bahamas, holding customer deposits. Alameda Research was a proprietary trading firm running its own book. Both were controlled by Sam Bankman-Fried, and on paper they were separate companies. Operationally, they were one balance sheet wearing two names, and every safeguard that was supposed to separate them existed only as a promise. Start with the plumbing. Early FTX struggled to get its own bank accounts, so customer wire deposits were routed into accounts controlled by Alameda, including a Delaware shell called North Dimension that deliberately did not carry the Alameda name, according to securities regulators. Customer cash landed inside the trading firm from day one. What customers were owed existed only as an internal ledger entry, an account labeled fiat at FTX.com. Now the code. In July 2019, at Bankman-Fried's direction, FTX's engineers added a flag to the exchange database, allow negative, applied to Alameda's account alone. Every other customer whose margin went negative was automatically liquidated by FTX's celebrated risk engine. Alameda was exempt. It could withdraw beyond its balance without collateral, on a line of credit that co-founder Gary Wang testified was eventually set at $65 billion, so they would not hit the limit again. Third, the collateral. FTT was FTX's own exchange token, printed by FTX, allocated cheaply to Alameda at launch, and accepted by FTX as margin. Follow the loop. The exchange prints a token. Its trading firm holds most of it. The trading firm posts the token back as collateral and borrows real dollars against it from outside lenders, and through that database flag from customers. The asset securing customer money was the exchange's own script. The hole was dug in June 2022, 5 months before anyone ran. When the Luna collapse took down Three Arrows Capital and froze crypto credit, lenders recalled roughly $10 billion of open-term loans to Alameda. Alameda's assets were locked tokens, venture stakes, and FTT. Its debts were due in dollars, on demand. Caroline Ellison, Alameda's chief executive, testified that at Bankman-Fried's direction, the firm repaid those lenders with FTX customer deposits. Inside the company, the number was known precisely. That same June, a ledger bug showed Alameda owing $16 billion. When a developer fixed the bug, the corrected figure was still roughly $8 billion of customer money gone. Ellison prepared 7 alternative balance sheets to hide the borrowing from lenders. And Bankman-Fried told a colleague, on a paddle tennis court in the Bahamas, "We were bulletproof last year. We are not bulletproof this year." From that moment, FTX operated as a fractional reserve exchange, solvent only if nobody redeemed and FTT held its mark. Then, on November 2nd, CoinDesk's Allison published Alameda's private balance sheet. $14.6 billion of stated assets, roughly 40% of it FTT and FTT collateral, about $8 billion in liabilities, mostly loans, and $134 million of actual cash. One piece of arithmetic did the killing. Only about 197 million FTT tokens, roughly $5 billion worth, existed in circulation. Alameda's stated FTT position was larger than the entire circulating float. You cannot sell a position the market cannot absorb. Those marks were unrealizable by construction. A working trader reads that sheet in 10 seconds. The asset side was the liability side wearing a mask. Binance had both motive and ammunition. When FTX bought out Binance's early equity stake in 2021, it paid roughly $2.1 billion, partly in FTT. On November 6th, Binance chief Changpeng Zhao tweeted that he would liquidate the remainder, roughly 23 million tokens, worth about $500 million. His stated reason was post-exit risk management. His cited precedent, pointedly, was Luna. 16 minutes later, by some accounts, Alameda's CEO answered publicly, "Alameda will happily buy it all from you today at $22. To a trading desk, that tweet is a gift. A publicly named defense line means finite reserves standing against unlimited selling, with margin triggers waiting just beneath it. Bloomberg's later analysis of the trade data called that tweet FTX's point of no return. The run began that night at roughly $100 million an hour. Over about 72 hours, somewhere between $5 and $6 billion in withdrawal requests hit the exchange. On November 7th, Bankman-Fried tweeted, "FTX is fine. Assets are fine. We don't invest client assets." He would delete that thread within a day, and a jury would later hear exactly how false it was. November 8th, the $22 line broke. FTT fell roughly 80% in a single day, from $22 toward $4, erasing more than $2 billion of token value, and with it, the collateral under the entire structure. FTX halted withdrawals and signed a non-binding letter of intent to be acquired by Binance. That same day, Bloomberg cut Bankman-Fried's estimated net worth by roughly 94%, the largest one-day collapse its billionaires index had ever recorded. Binance examined the books for less than 24 hours and walked away, citing mishandled customer funds and reports of American investigations. The rescuers' retreat told the market what the balance sheet already had. The hole was unfixable. Bitcoin fell to a 2-year low near $16,000, and Solana, Alameda's flagship position, dropped another 20%. On November 11th, FTX, FTX US, Alameda Research, and roughly 130 affiliated entities filed for Chapter 11 in Delaware, with creditors later estimated at over 1 million. Bankman-Fried resigned. John Ray III, the man who liquidated Enron, took over and delivered the epitaph. "Never in my career have I seen such a complete failure of corporate controls." Then on bankruptcy night, the corpse itself was robbed. More than $400 million drained out of FTX's wallets within hours of the filing. Speculation blamed insiders. According to a federal indictment unsealed in 2024, it was an outside SIM swap crew, a fake ID at a Texas phone store, a hijacked employee phone number, intercepted authentication codes. The human ledger closed slowly. Bankman-Fried was arrested in the Bahamas that December, and in October 2023, a jury convicted him on all 7 counts: wire fraud, conspiracy, money laundering, after less than 5 hours of deliberation. 25 years in prison, plus an $11 billion forfeiture order. In June 2026, the appeals court affirmed everything, calling him the main driver of one of the largest frauds on record. The cooperators traded testimony for leniency. Ellison received 2 years, while Gary Wang and Nishad Singh, the men who wrote and applied the code, served no prison time at all. The man who pulled the trigger took his own hit. Binance pled guilty to anti-money laundering failures, paid $4.3 billion, and Zhao served 4 months, then received a presidential pardon in 2025. Binance remains the largest exchange on Earth. Now the epilogue the apologists cite. Customers were repaid at 119%. Read the fine print like a trader. Claims were frozen at November 2022 prices, Bitcoin near $17,000 and paid in cash years later, while Bitcoin traded near $100,000. A customer's 1 Bitcoin claim paid out roughly $19,000, made whole in dollars, crushed in coins. The autopsy always identifies who fed. Distressed debt funds bought customer claims for as little as 3 cents on the dollar and collected par plus interest. Bankruptcy professionals billed roughly $1 billion in fees, and the estate's best recovery was an accident. A $500 million venture stake in the artificial intelligence company Anthropic, bought with customer money, later sold for about $1.3 billion. And what changed? No single FTX law was ever passed. Europe's MiCA regime now mandates segregation of client assets. The United States eventually passed a federal stablecoin framework, and exchanges began publishing proof of reserves attestations, note not audits. The specific flaw FTX exploited, an offshore exchange quietly lending customer assets to its own trading firm, was never engineered away. It remains a matter of jurisdiction and of trust. So record the finding. FTX did not die of a bank run. The run was the coroner arriving. It died in June 2022, when recalled loans were repaid with customer deposits through a flag in the exchange's own risk engine, leaving a roughly $8 billion hole collateralized by self-printed paper marked above its own float. CoinDesk photographed the fiction. Binance announced it was selling it. And in 72 hours, the market did what markets eventually do to every fiction. It repriced it to the truth.